For the better part of 20 years, from the aftermath of the internet bubble through the pandemic, stock/bond correlations were consistently negative, making treasury bonds an effective portfolio hedge. That long negative correlation era, roughly 2000 to 2021, is what shaped the design philosophy of target date funds. Then the correlation flipped sharply and painfully. In 2022, the Fed instituted the fastest monetary tightening since the Volcker shock. Stocks fell by about 25%, and treasury bonds dropped about 17%. For the first time since 1958 to 1959, both fell together. This was a brutal real-world test of the target date fund assumption, and it failed badly. Retirees held balanced funds and got no protection. The picture has been shifting back but remains uncertain. Correlations between stocks and bonds stood at about plus 0.3 for the 12-month period through April 2025. The key variable is inflation. At low inflation, correlations are negative. Higher inflation typically links to lower stock and bond prices simultaneously. The most concerning scenarios involve extreme inflation, or if rates rise to compensate for higher government debt. Both are live concerns given current deficits. In plain terms, the central safety mechanism, that bonds zig when stocks zag, is not a law of nature. It's a feature of a specific macroeconomic regime. Investors in or near retirement who rely on target date funds may be taking more correlated risk than they realize if inflation remains elevated. Ceding control of your asset allocation to an algorithm predicated on historical data and which completely ignores your specific circumstances is dangerous. So much for set it and forget it autopilot. And that's why it's personal to me.